Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Fidelity Managed Portfolios has surpassed $50 billion in assets. So we need to have a little bit of a party hat on for this one. With several solutions to choose from, Fidelity Managed Portfolios utilize a range of investment styles to fit your needs. How is the Global Asset Allocation team working to continue driving performance for investors? And why should advisors consider incorporating them into client RRSPs in this season? Joining us here today to unpack some of the latest market action influencing the Global Asset Allocation team is portfolio manager David Wolf. Welcome, congratulations.
Thank you.
That is a huge landmark to surpass.
Yeah, no, it's quite a milestone, and we're on the team, both myself, my co-managers, and everybody that supports us are really gratified with the reception that these funds have gotten into the market. So I started on these funds in 2013, and we made these funds active or tactical, which is to say, rather than being static 60-40 or whatever it is, say, okay, we're going to be active in terms of our asset allocation approach, as well as active on security selection, so picking stocks and bonds in terms of our underlying managers. And the suite has gone from, I believe it was a little under 3 billion when I started, to, as you mentioned, over 50. So that's some pretty good growth over time. Part of that is the market, no question, but I think a lot of it is the performance we've been able to drive and folks recognizing that and wanting to be involved. And I think it's worked out well for everyone.
So $50 billion surpasses for the managed portfolios. What do you manage overall? Because you manage many other funds as well.
Yeah, it's about 100.
Okay, about 100 billion. Yeah, roughly.
So, but I will say, we never take that trust for granted. So that's an awesome responsibility. So just
yes, it really is.
In the managed portfolios, it's over 600,000 individual investors in Canada that are involved in these funds, and we feel that every day. You know what? It's a great motivator. At least I'll speak for myself. So I'm involved in these funds. My son is. My ex-wife is, which is actually kind of a story that maybe we can get to later. But
that's great. Your ex-wife invests. She says, "I'm happy." He's a really good asset allocator. I'm going to invest.
Yeah, there's a story there. Maybe next time I'm on, I'll tell it. It's a little bit longer.
Sounds good.
But yeah, she's a proof point, I guess you could say.
Yes.
But no, overall, I mean, I know that if I do my job well, then there are 600,000 people in Canada that have more resources for their families, for retirement, to send their kids to school, what have you. And that's really meaningful. And as you know, I used to be a public servant at the Bank of Canada.
Yes.
And that public service was really lent a lot of meaning to my job. And I think that there's part of it that is still here as a PM at Fidelity to say, if I do my job well, that's good for an awful lot of people, and that is one of the biggest things that gets me up every morning and in front of my screens with a cup of coffee way too early.
That's wonderful. Yeah, way too early. Well, but it's fascinating to see what's happened. It's a lifelong love of the markets. Clearly, it's what you have here. Now, speaking of these markets, it is a remarkable moment. I mean, how do you, when you wake up with your cup of coffee and take a look at all the screens, digest some of the truly massive pieces that are moving around in the economy? There's sort of birthing pangs of what seems like a new economy being built. What do you do with all of this?
Yeah, it is a remarkable environment and one that I don't think anyone alive has ever seen. But I mean, that doesn't absolve us of the responsibility to invest responsibly and take the world as we have it and try to make the best of it for our investors. So maybe a few comments. So first, a couple of things that we're not doing. One, we're not panicking. I can understand the temptation, and a lot of folks I talk to, advisors and others, like, am I not supposed to just buy a bunch of cash or buy gold and hide from all of this? And I can understand the temptation to do that, but that's almost always the wrong thing to do. Yeah. So we're not panicking, we're not hiding under a rock, we're taking the world as we find it. The other thing we're not doing is reacting to every headline, and there are a lot of them. You get tariffs are going on and markets move. Oh, they're not. Oh, they are. Or they're not. I mean, you can get whipped around pretty good if you try to react to all that. We don't do that. We never do that. And particularly in this environment, we see that as noise. If it's going to affect the markets a year from now, we'll act on it. If it's going to affect the market for an hour or a day, we're not going to react to that, because that's a good way to lose a lot of money.
I'm sure that's correct. I'm very glad to hear you don't do that. But what do you do with sort of the direction of travel of tariffs? Because there seems to be a direction of travel.
Right. So we'll get to tariffs in a moment and specifically
Okay.
the consequences for Canada, but just the overall approach. So I mentioned what we're not doing. What we are doing is running, as we always do, our disciplined investment process as asset allocators. And that's 4 pillars, and I think a lot of folks that are listening now have heard us talk about this before. So let's see where we are on that. So the first pillar is the macro. The macro is weird at this point.
It's huge.
It's highly uncertain. The outcomes that are possible it's a much wider range than we're used to. And we recognize that. We recognize that neither we nor anyone else is going to have a good handle or be able to have a particularly high conviction view on how all of this turns out. So we're relying less on that macro pillar in terms of the investment decisions that we're making, and relying more, for example, on the second pillar, which is the bottom up. So that's all of the intelligence that we get from our underlying equity managers, fixed income managers, the analysts who support them, et cetera. And we're in close touch with them and asking questions not only about what they're doing with the sleeves that roll up into our funds, but also what are they hearing from companies? Are they scared? Are they bewildered? Are they investing? Are they hiring? Or what are they doing? Because the impact of this environment in terms of the aggregate economy is going to be seen there first before it gets into the overall data. So we're spending a lot of time with that and guiding our decisions that way. The third pillar is valuation. We kind of are where we were that way. Markets actually, surprisingly for some, haven't really moved much on net since Trump became president 3 weeks ago.
Yeah.
Seems like longer than
seems
3
like
weeks.
Longer, but yep, it is.
So markets really haven't, so valuations kind of are what they were. The US market is still expensive, there's no question about that, and we're taking the approach that we have been for some time, which is really identifying that high level of valuations at the very top end of the market with the Magnificent Seven, and stress testing those valuations with our underlying analysts who know these companies better than anyone to say, is this level of valuation justified by the longer term growth and earnings outlooks for these companies? And the answer keeps coming back, yes. And so in that environment, obviously we'd love to buy things cheaper rather than more expensive, but we think those valuations are no barrier to things getting better. The other thing I would say about valuations in the Magnificent Seven is, so you see the heads of the Magnificent Seven companies standing in the front row behind the president at the inauguration.
It was quite a visual, wasn't it?
Yeah, it was quite a visual, and we work on economics and financial fundamentals and not politics, but it probably doesn't seem like a great idea to be betting against the Magnificent Seven in that context, and we don't have to unpack that any more than that. And then the final pillar is sentiment, and sentiment is actually pretty skittish at this point, and not surprisingly so given everything that's going on, and that tends to be a good contrarian indicator. You be greedy when others are fearful and vice versa. So when we sum it all up together, it's still a reasonable environment to be involved. And we're prudent, we've pared back our active risk a little bit. We're still pretty fully invested. We're prepared to make changes, perhaps big changes as things evolve. But from where we sit right now, granted the uncertainty, still looks pretty good.
So US equities still look pretty good. There's other things too, but that piece of it still looks pretty good.
Yeah, I mean, we're still slightly overweight equities in the asset allocation funds. We're still somewhat underweight Canadian equities, and that's a piece on tariffs that we should unpack. I mean, everybody listening, everybody in Canada knows that this is a threat, and it's maybe not just a tariff threat, but there seems to be some at least perceived seriousness behind this threat of annexation, and there are a lot of things that we can talk about, both as financial people and as Canadians about that. But let me talk maybe a little bit about how we're seeing the specific tariff threat, the impact on the economy, the impact on markets, and then how we're dealing with that in terms of the positioning of the funds. So, so tariff, maybe just level set for everyone. Tariff is a tax. Okay. It's an import tax.
Is it a tax on growth?
Well, it's a tax on growth. It's a tax on activity, and specifically a tax on imports, right? So if you're a Canadian company, you sell something into the US importer pays a 25% tax on that import to the US government, right? So it's not Canada paying, it's the US paying, and that US importer. But if it's going to be more expensive for that US importer, they're going to buy less from Canada. So that's the hit to growth. And then you think about what happens then. Well, one of the ways that you offset that hit to growth from that tax is for Canadian companies to cut their price, right? Because if you put a 25% tariff on, if Canadian companies drop their price by 20%, the math works out that it actually ends up being the same for the Americans, and so nothing changes.
Considering our dollars in there.
Well, so then the question becomes, how do you cut the price of everything in Canada by 20%? Currency goes down 20%. So that's a very naive kind of thought experiment to go on. You've had a lot of folks who are really very good at this, primarily the Bank of Canada, using their very large-scale general equilibrium models to say, if you get these tariffs, if you get retaliation, and all of the different channels through which that impact of that tax is going to work through, what happens to growth, what happens to inflation, what happens to Canadian dollar. Turns out that 20% is actually not that far off when you get this serious,
so the naive
fully
version
loaded.
is not so bad?
Yeah, I mean, we like it when that happens, right? We don't like it when the currency goes to that 20%. So, okay, so that's, if you got tariffs of 25%, full retaliation, full, channel impact, had those on forever,
right?
That's probably 20% down on the currency, which is a lot. And that's from here at 70 cents. And I won't say what number that is, but you can do the quick arithmetic on that. But how likely is that? I mean, that looked like maybe it was coming, a week ago, and now it's not, and maybe it is, and it's not. The key point that I would make is there's uncertainty around, is it going to go on at all? And if so, how long will it last? Is it a bargaining technique? Is that actually something that's going to be implemented? And so what the market is trying to do, and we'll specifically talk about the Canadian dollar, is it's sort of desperately trying to discount how likely is this and how long it will last.
With each headline, isn't it?
With each headline. I mean, I walked in here, an hour ago this morning, right? And there was just a news story saying, well, Trump considering deferring tariffs from the beginning of March to beginning of April, and the currency went up half a cent. So last week, and it's hard to believe it was only last week, on Monday when it looked like tariffs were going in, Canadian dollar went down 2 cents. Then, oh no, just kidding, and Canadian dollar goes up 2 cents. So as I mentioned earlier, we're not going to react to that. Yeah. We're looking out over the longer term. And so when you think about the longer term, okay, we have kind of the guardrails, so sort of ceiling and floor is the way I think about it. So if you got those tariffs and they're on and they're effectively forever, we know the downside of the Canadian dollar is probably below 60 cents, so something that we've never seen before. What is the upside? Well, the upside, if this tariff threat went away entirely, is probably not that far above where we are presently at around 70 cents. If you look at underlying growth dynamics, inflation dynamics, where interest rates are and where they're going, et cetera. So the Canadian dollar is probably pretty fairly valued on that basis. So there's probably not very much upside. And if the worst happens, there's an awful lot of downside. And so, if you're in my seat and you say, what kind of active positions do you want to have? You want to have active positions that may profit handsomely and actually have relatively little downside to them. And being long the US dollar versus the Canadian dollar is one of those positions, given that asymmetry. So that's
how you're dealing with it. I mean, that's how you're viewing it and planning for it. Tell us a little bit about what it would take for you to invest. You hear a little bit about a relief rally after being pummeled for a while, or maybe for a year. How long with the tariff threats and then whatever implementation there is. But that there might be sort of a light at the end of the tunnel type rally. What would the Canadian dollar have to price in, I guess, and look like for you to be interested? I
mean, if we kind of step back and think about what's happening here, and again, this is as much as Canadians as, portfolio managers or financial people generally or what have you. So it's been clear in terms of the public discourse and our own feelings, you probably feel it, I certainly feel it as Canadians, to say, it looks like we've been kicked in the pants because we realize we've kind of taken the path of least resistance and
for years past?
Become overly reliant on the United States, economy, security, et cetera. And we thought that was okay. It's now clear that that was not as okay. Right. And so how do you deal with that? Well, I think there are a lot of things that are starting to happen even now, and it'll take some time, that will put Canada in better stead over the long term. So these are things like, making ourselves more self-sufficient and less reliant on the U.S. It's breaking down interprovincial trade barriers, East-West pipeline, looking for other trading partners, et cetera. These are things that are going to take an awful long time to do.
Some of the trade barriers might come down quickly, though.
Yeah.
Whereas building a pipeline will take longer.
Some is less time, some is more time. I mean, we've become more and more reliant on the United States for decades. That's not going to unwind immediately. So there's going to be a period of difficulty. But my hope is that this is a sufficient, as I said, kick in the pants for us as a country to make the kind of changes that will serve us in better stead over the long term. Now, back to how do we deal with that as fund managers?
Yeah.
And when we'd be
how do you
overweight.
invest that?
Yeah, so there's going to be a period of pain, and we'll see how bad it is, and there'll be adjustments to that. One thing that markets tend to do is overreact. So, I don't know how far the Canadian dollar falls under those scenarios. Again, we have guardrails around it, but we'll see. But there will probably come a time where the market is discounting Canada being in lousy shape in terms of the outlook forever, right?
Okay.
And again,
like
we'll
dire.
see. Yeah, like dire, and there's no light at the end of the tunnel, even when, as I said, there are probably going to be some positive things over the long term kind of bubbling under the surface. So, the question on being overweight, no matter what the outlook, there's always a price where an investment makes sense. And so if the price of Canada, Canadian dollar, TSX, Canadian bonds, et cetera, is discounting no light at the end of the tunnel, we will be buying a lot of it because, again, I think there are some very positive changes that can come out of this.
Okay.
And so if we can harness those changes at a very attractive price, that's something we're always going to do in the funds. So in the 12 years I've been doing this, we haven't been in that position.
Yeah.
But as both a fund manager and as a Canadian, I hope that we are going forward.
So that's new and really interesting. I mean, it adds to these sort of remarkable times that we're in on the investment side. Thank you for explaining that. There was a period of time where we were talking a lot about the rate story in Canada. We talk about it more broadly, what the Fed's doing. Is the Fed stuck? The Fed's sort of sitting there. They can't do a whole lot. The Bank of Canada at one point, it was said, with every cut, they're watching the potential of the loonie just dropping like a rock. So they're sort of cognizant of that they had to cut, and this far better than any of us, but just keeping an eye on the currency. How is that unfolding at this point where we are seeing the cuts? I mean, they're coming.
Yeah, so maybe a couple of things on that. So first, if you get fully loaded tariffs, then the Canadian dollar will fall. Part of the reason the Canadian dollar falls is you need some pretty serious interest rate cuts, even from here in Canada.
Right.
And the quirk is, and I think this is probably not understood as well publicly, if you're the Bank of Canada, you want that. You need that as part of you need the weaker currency.
If you're the Bank of Canada, you need the weaker currency.
You need the weaker currency if you have this tariff threat implemented, because it's going to be very, very hard on growth. Yes, it pushes inflation up, but that's more of a temporary level effect. The really important effect that the bank will be looking at is, listen, you just raised prices for 25% for everything we sell. We're not going to be able to sell as much. We're an export-driven economy. That's really bad for growth. That's recession, worse than we had in the early 1990s. So they need to cut a lot. But cutting rates, like we know where the housing market is. We know we have a mortgage reset shock coming this year and next year, et cetera. You can cut rates as much as you want, but unless you get term rates down a lot, and with US rates where they are, you're not going to get those term rates down a lot, is not going to make much difference in terms of the interest rate sensitive sectors of the economy. You cut rates because you need the currency to be weaker for us to be more competitive.
We're making news here.
Well, no, it's not a bug, it's a feature. Now,
exactly.
If you're a central bank, you can't really talk this way. And so the bank, put out a paper following up on a piece that they had in the monetary policy report last week, week before. You lose track of days when we have.
It's been a busy time.
It's been a busy time, right? So they talked about how interest rate cuts in Canada are actually not the big factor driving the currency. It's other stuff.
Yes, they did.
And
is that true?
Well,
ish.
It felt a little bit like
Communication
thou dost
strategy?
protest too much.
Right.
Like, I mean, let's be serious. If the Bank of Canada dropped rates to 0 tomorrow, the analysis they presented would say the Canadian dollar would only go down about 1.50 cents.
But there's
I
no
think
way
all
that
of
could
us
be. Yeah.
understand that they would go down a lot more than 1.50 cents, right? So that was a little bit about kind of, don't blame us if this happens. But as I said, economically and from a policy point of view, if you have a huge threat to external demand that's going to be a huge threat to your overall economy, what do you do about that? You need to be more competitive and crowd foreign demand in. How do you do that? It's the exchange rate.
Wow,
So
super cool. That was amazing. Okay, there's a question. Yeah, you've kind of answered this, but let's put this to you. So what are your thoughts on the resilience in equity markets? It's a broad question, but it goes to valuations probably.
Yeah, so I mean, it's something that we talk about within our group,
sure.
and not just here in Canada, but so I'm part of the broader Fidelity Asset Allocation effort based in Boston, and that's our center of excellence globally for Fidelity. And our broad group runs close to $2 trillion in multi-asset funds. So I'm actually kind of the minnow at the table when we have these conversations with $100 billion, and they're remarkable conversations. And just I've mentioned this in a number of appearances. I wish advisors, investors could be kind of a fly on the wall in these conversations.
So do we, yeah.
Because there's so much money represented in the room, but you would kind of never know it. Everybody is informal and everybody is collegial, and we're just all trying to help each other make the best decisions that we can. So they're wonderful conversations. That comes up all the time now. They're like, the world is odd, and there are all these unprecedented things going on, and one thing that we know the markets don't like is uncertainty, and you've got an awful lot of uncertainty, so how are they holding up? And that's a totally reasonable question. I ask myself and my colleagues that question all the time, and the answer seems to be, and I think there's some credence to this, that the primary barometer by which the president evaluates his impact, his kind of scorecard, is the equity market. And so the thinking is that a lot of what's happening and a lot of the threats is kind of bluff, in the sense that if it really did start to impact equity markets, and we saw a little bit in earnings, and we saw a little bit of that last week, there would be a quick pullback. And I think people are confident enough in that to remain invested. I don't think you can be 100% confident in that. Right. But we're not just, sort of play while the music is. I mean,
real.
We talk about this every day. So, and one of the things that I think is really important, and one of the reasons why we have the active allocation approach that we have, is if that changes, if the environment changes in a radical way where we need to make adjustments, we're not going to stand on ceremony on a quarterly rebalancing or whatever folks do. We're going to act, and we do.
Right, you're going to act. Is there something to the discussion of broadening within the U.S. equity markets that it's been a weird cycle? Kind of people who look at it differently, but the idea of sort of smaller caps or just this broadening out trade that might be interesting. Maybe later on, there's an interest rate impulse there, but there's also. I want to ask you a question about small caps and sort of going down the cap spectrum away from the Mag 7, which have been extremely successful.
Yeah, so one way of looking at the world, and I know Urian talks about this a fair bit, and he's right, is that everything in the world has been kind of the same trade over the past number of years. So it's US doing better than rest of the world. It's large cap doing better than small cap. It's growth doing better than value. And so everywhere, it's all, US dollar doing better than Canadian or Euro or whatever. It's all part of the same trade. So what we're talking about is how much does that reverse itself, and how do you play that? So we're diversified. It's not going to surprise you to hear me say that. We have, we're fully invested in sort of the top end of the US market, but we also have holdings of small cap. We have holdings of EFI, emerging markets, other currencies, not only in equity space, but in debt space as well, which is particularly important. And, in that environment, it's really important to remain kind of diversified, because you don't know if that broad trade goes from one end to the other. You don't know what's going to outperform. the one nuance that I would mention, and you talked about small caps, is to say that it seems to us, given everything that's happening with tariffs and Fortress America, what have you, it's kind of safer to play that broadening trade within the US in small caps than it is to be owning Europe or Japan or China or what have you. So we have holdings in all of those areas, and we have active managers who are picking the right companies in those areas. But for us as an asset allocation point of view, how do we play the broadening trade? We'd rather do it in US small cap than in other parts of the world.
Right, you prefer to that. As we sort of close out here, we started talking a little bit about what the managed portfolios have surpassed in terms of what they're worth. Also within the RRSP season, I think for those just investing for the long term, which is always the way Fidelity looks at things, what might you say broadly for those that are probably about to make an allocation to their RRSP? Just they're thinking about the future, thinking about their retirement, they're thinking about and they're in a remarkable market as we started. What might be a final thought?
Yeah, I mean, maybe a couple of things. I can't stick to just one thought.
Fine.
I mean,
you can
one, it's a scary
fine.
time, but there are a lot of times that are scary times. And whenever we've had these scary times in the past, we look out 10, 20, 30 years ago, you can barely see them, right? So, there's always a tomorrow, and I could invest tomorrow, and that's usually, I'm sometimes a procrastinator, and that can slide for years. Mm-hmm. And so, just being scared is not a reason to hesitate, and we try to take emotion out of this. And the second thing is, we are diversified. I mean, my job is diversification. It's risk-adjusted return, not just return. So to make sure that we have investments properly spread all over the place to drive performance, regardless of the environment. If everything goes down, our funds are going to go down. That you can't avoid that. Okay. But I think coming full circle, we showed the performance we've been able to generate over the past 12 years in these funds, and we're going to keep doing it.
Yeah, we're going to keep doing it. David Wolf, it is always fascinating to hear what you have to say about the world that we're living in and how you're investing in. Thank you for your time.
Thank you.
It's David Wolf joining us here today.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.